Credit union community, these are your three topics for today's show. First up, are some credit union CEOs cashing in on mergers as golden parachutes? Next up, 96% of credit unions are not in the small business lending game. Can they overcome the regulatory hurdles and turn it into a growth engine? And finally, is the CDFI fund a smart investment or just another government handout? We're breaking down these topics and more. Welcome to Grow Your Credit Union. This is the podcast where credit union leaders gather, learn, and grow. I am your host, Joshua Barclay. And before we start, if you have any topics that you want us to cover on the show, reach out to me personally at joshua@growyourcreditunion.com. All right, today my co-host is back in the mix, Becky Reed. Happy to have you back as my co-pilot.
Oh, thank you, Josh.
Before we begin today's show, I want to mention our sponsor, PFP Services. You will hear more about them later on in the show. Becky, you are right now recording with us from San Diego at the Correlation event. Tell me your learnings, insights, anything cool you saw or heard at the show.
Well, I've been a long-time Correlation fan. Lone Star Credit Union converted to Correlation in 2017, and I was on their advisory board. So they're a fantastic core. And one of the things that my colleague John mentioned to me while we were here with Bank Social, and he said the feeling of this conference feels a little bit different than some of the other conferences, especially core conferences, because their customers aren't pissed off. I was like, that's kind of true. But good news, too, is a lot of people have come up to me at this conference and told me how much they love our show. So Grow Your Credit Union is pretty popular amongst Correlation clients, apparently.
I love it. Okay, Correlation. Hey, we love you back. Yeah, and that's hilarious, by the way, because you are right. Most people, you talk to them about their core and they're like, are we off the record? Because I'll tell you how I really feel, We got an awesome show, but I don't need to say that, Becky, because pretty much every show is awesome. Today's guest is brought to us by our sponsor, PFP Services. Please welcome the CEO of Nutmeg State Financial Credit Union, John Holt. John, welcome to Grow Your Credit Union.
How you doing? Thanks for having me.
This question actually came in from a listener. His name is Justin Hool. He's the VP and CFO at Heartland Credit Union. He said he's been seeing retiring CEOs push mergers, not for strategy, but for personal payout. Now, that is a move that can erase local credit unions and honestly sideline the next generation of leaders. So, John, do you think some credit union mergers are, in fact, being driven more by CEO exit strategies than by what's best for the members?
So I haven't experienced that, and we're going on our third merger. So the first one we completed probably 5 years ago, small credit union, 30 million, and there was nothing given to the CEO at all. We absorbed him into our staff. The second one we just did completed in January. That CEO already had a contract and all of the things that go along with that, including his retirement plans. And he was going to stay on. And then once it got going, he decided to exit. We did pay him out his contract. And the third one that we're working on that we just announced this past week, quite honestly, the CEO had no retirement plans at all. There was absolutely nothing. And she had been working in the industry for 50 years and got nothing from it. So her board did put some stuff into place just before the merger, which was appropriate. And quite honestly, they were planning to do it anyway, whether we merged or not. It was more coincidental. And what we did is we made a deal where we would pay her taxes on the particular retirement plan that they put into place for her. And I suppose there's probably some CEOs that do that, but any credit union that I would merge with, it has to be realistic. because it's all about what's best for the member. And all of these things are disclosed. They're disclosed to the NCUA. They're all public. All of the information is public. Anyone can see it. So I don't think you want to necessarily do things that are too outrageous, because I'm not sure how that would go over with the membership or the communities. But in some cases, I think it does make sense to do something, because you're getting all of the capital from these credit unions, you're getting the membership, you're getting the branches in some cases. And I'm going to go back to the capital. In our case, this latest merger is going to give us $16 million in capital. And if I have to pay somebody a little bit of money to get that capital, which would take absolutely forever to get, I mean, it would take us years to get that amount of capital, even with strong earnings. So to me, you have to look at it both ways. And then their membership, this credit union we're merging with currently in the process of, I mean, all these members are going to get better technology. They're going to get more branches. They're going to get more products and services. And our strategies align perfectly to what the membership wants. So I think the situation, I'm sure there's some things that look a little strange, but I haven't come across that. And I don't know if I would fully support it if I thought that that's exactly what was happening with a credit union I was merging with.
John, very, very nuanced answer. I like that. It's not as cut and dry. Justin, I'm sorry if you were looking for a more controversial take. Although, wait a second, because we have Becky Reed coming in next, who may have a more controversial take. Becky, what do you think about what Justin was asking? Do you see some credit union mergers being sort of the golden parachute for that particular CEO at the organization?
In some cases, yes. And it goes back to John's answer for one of the situations that he described earlier, in that the credit union board has not put a retirement plan in place for their CEO. And in the smaller credit union category, I hate to say that is quite common, actually. And I'm going to go further and say it happens to women at small credit unions way more than it happens to men in small credit unions. Now, why is that? Because most women are not the major breadwinner in their family. This is a second income job. They've worked there for a long time, and they don't feel comfortable standing up for themselves and making sure that that happens. Whereas, frankly, a lot of times men do. And so because they haven't done that, that's kind of where that whole succession planning thing comes in. You know, there's a big controversial thing, NCUA mandates succession planning and all this stuff because, now people are merging because there's no succession plan and whatever. But unfortunately, I mean, that's a terrible situation. And it can seem like maybe that's the reason the CEO has made the decision to merge. Now, we all know lots of other people have to make the decision to merge. It's not just the CEO's decision. Certainly, the CEO can facilitate those discussions. The CEO might start those discussions, but it's the board and the membership at the end of the day. And John is absolutely right. NCUA does require that all of those things are disclosed publicly, which is why people write about it, because those things are public. And sometimes, to be fair, things can be taken out of context. It's kind of like saying, oh my gosh, these CEOs of these giant companies are making billions of dollars a year. And it's because the dollars a year that they're disclosing as compensation are things like stock options and, non-cash compensation that makes it sound just like a crazy number, when in reality, it's just not. And when you compare it to the annual revenue of the company, $2 million salary just isn't that big of a deal. So I'm not saying credit unions earn that kind of money, but it's a similar kind of thing. Somebody's worked 50 years for a financial institution. They have no retirement plan in place. Putting $1 million into a retirement plan or 457F or something for this person, or into an IRA. I mean, for 50 years worth of service, it sounds a lot more controversial than it is. So that would be my kind of double-sided answer.
Yeah. And I think one of the things that I'll add to also to this is that, I mean, if there's a payout or payouts, because sometimes it involves more than the CEO. I mean, we've had put contracts into place for some of the executives who've had nothing. They've had no contracts. They've had no bonus plans. They've had no retirement plans. I mean, if you eat up all of the capital for payouts like that, that's probably a little noticeable in some cases. And I've also read some of those particular situations where that's happened, but I don't know if that would be healthy. And I would wonder at the end of the day, what would happen with a situation like that. The things that we're doing are not out of the ordinary. I think that they're justified. I think they make sense. And when you look at the big picture of what you're getting, not only capital and all the other things I talked about, I think those are the things that really matter. It's like, what value, what additional value add can you bring to the membership? And in some cases, in this particular situation, the other CEO that had retired had used a large portion of that 25% that is only allowed in non-permissible investments for retirement plans. So they didn't think there was a way around it. We were able to work with Gallagher and figure a way around that.
According to the NCUA, federally insured credit unions saw a 22% jump in commercial lending in 2022. Now, some are saying that that is a signal that more credit unions are stepping up to serve small and mid-sized businesses despite the regulatory hurdles. But designing sound loan policies and training staff to manage complex business accounts is not easy for credit unions. In fact, probably many would say the risk still outweighs the reward. So my question for you, John, is it really possible, given the regulatory hurdles, for credit unions to step up in small business lending and use that as a real driver of growth?
Yeah, we are in commercial lending. We started it. I got to Nutmeg in 2010. So we started it probably 2011 or 2012. And we used a consulting firm to get us going, developed it. We focused on small business. We didn't do anything crazy. And then as time went on, we got took a little more risk, got a little more resources with experience, trained an inside person, sent them to the Q's Business Lending School for 3 years. And our portfolio is about $70 million right now. Now what we're doing is we're taking a step back and we're getting ready to launch something even bigger. So with that 69 million or so in our portfolio, we're going to go the extra mile and create a bigger portion of the business around deposits and treasury services like ACH, direct deposit, and all of the things that the small businesses or a medium-sized business or a large business would need from us. We found out that the experience is key to this. So we hired an individual just recently who had been at a very large credit union out west, who had worked for a couple large banks and had a lot of credit analysis background, was a credit manager, so knows the insides and outs of all the underwriting. And so we'll be able to take away the consulting firm eventually and put everything to him and some of the team that he's hiring. And we believe that it's going to be huge for us, especially around the addition of the deposits and the additional treasury services that will come along with what we're doing. And we're using True Treasury, the QSO, to help us with the treasury services here at Nutmeg. But I think it's a huge win for small businesses to work with a credit union versus a large bank. It's more personalized. We can sit down, we can look at different options, we can find out what's best for the business. So I think it makes a lot of sense. The challenge, I think, is we have a CDFI designation now. That's probably not going to last. And I know that's going to be another topic of conversation, and I'll explain why. The challenge now is if you're not LID certified or you don't have CDFI, you're capped. And so we have to be careful of that or find another way around that, which there's other ways around that, including participating out portions of perhaps a large loan. But again, our focus is on the small business, the startup business, and figuring a way out to help businesses get going. without, taking too much risk. So that's where we're at Nutmeg right now.
I love that you're doing it. So many people that I talk to, they dance around that particular question and, there's regulatory hurdles and we can't do it because of X, Y, Z. So Becky, you're very much a person who believes that anything can be done. You just heard that John is actively participating in small business lending, growing that share of the business. Let me give you a couple stats that I thought were really interesting when it comes to this topic. And one of them was by Carrie Talander Fortin. And she wrote that according to U.S. Small Business Administration, 96% of small businesses do not bank with credit unions. Now, let me pair that with another stat, Becky. Credit unions' share of new and used car loans is about 22.9% of the entire market in Q1, and that was down a little bit from 27%. So kind of what I want to attack here, Becky, is this idea that credit unions have been so heavy in auto lending, which you're giving a loan for a liability, and yet we only we only have about 4% of the small business market. So I guess this is a long-winded way of asking, do you see small business lending as the big future opportunity for credit unions? What's your take?
Short answer, it is an opportunity for credit unions because if we really mean to focus and invest in our communities, you have to invest in small business. That's how America works, right? And certainly we might have all started out being a consumer financial institution primarily, but guess what? It's members who start businesses. There's lots and lots of people who have sole proprietorships, side gigs, those kinds of things. And I think it's our responsibility as community financial institutions, community cooperative financial institutions to provide that service. And as a matter of fact, members a lot of times ask for those things. Now, what I'm going to address is the C word. I am sick and tired of credit unions saying, I can't. Wah, regulation, wah, it's too hard, wah, it's too much risk. Give me a break. Look, you just heard an excellent example of how John hired some people to help him implement a program at Nutmeg. That's genius. We have a thing at Bank Social that we say all the time, and it's think big, start small. You don't have to have a $70 million portfolio the first year you're doing these things. You also have to have an attractive deposit program, which is what they're using True Treasury for, because small businesses need those kinds of things too. They need way more than just loans. So you have to serve the holistic member, right? The member who's doing all of those things, who might need accounts payable assistance, who might need tax assistance. I mean, there's all kinds of ancillary products that you can add on to that help the end consumer, the member at the end of the day, regardless of if it's a business or not. And everybody's sitting around wringing their hands, talking about how hard it is and how they don't want to take a risk. There are CUSOs out there that handle all of these things. You can just go to a CUSO and actually plug into what they do and do all of this right away without having to build it yourself. So I just want to address that I can't. I'm sick and tired. I don't care what the size the credit union is. Okay. Everybody says, well, small credit unions say can't all the time. No. I hear big credit unions saying it too. And I'm tired of it because if our industry is full of can'ts, it's never going to be can.
I celebrate that. You're spot on with that. I think we need to be in a place where we can figure out how to do it. And there are a number of ways to figure things out. And that was kind of we're one of the only credit unions, in fact, maybe the only credit union in Connecticut that actually does business lending. And everyone was like, oh, it's too risky. Well, it depends on how you do it. It depends on what reporting you have. It depends on what audits that you have, so on and so forth. There's ways to manage it. And we've done just fine. We've had a few things here and there, but who wouldn't? I mean, businesses have had challenges, whether it's through COVID or any of that stuff. But I'm really super excited about what we're doing this year. And by the end of the year, we're going to have a full suite of deposit products and treasury services for businesses. And we have a really solid team now. So any small business or even medium-sized business. And we'll do large businesses too. We may have to participate out the loans or part of the loans, but I think it's a great opportunity. And what we also do is we ask for their employee accounts. So this isn't not just about the business. It's like, hey, let us come in there and talk about the credit union products and services and tell your employees the benefits of banking with a credit union. And so it becomes a bigger relationship than just that loan or that deposit product for the business.
Today's sponsor is PFP Services. For more than 50 years, PFP has worked exclusively with credit unions to grow membership, drive loan and deposit product growth, as well as non-interest income to the bottom line for their partners. That's why they are announcing their groundbreaking 2025 seminar series, Access, Your Credit Union's Currency for Organic Growth. This dynamic seminar, set to take place in select regions across the country, is designed to challenge and transform how credit unions think about their most vital resource, access. With the evolving landscape of financial services, credit unions must assess and elevate their reach and engagement with members. Whether through physical branches, digital avenues, or over the phone, true value is measured by how effectively you connect with the communities you serve. In this seminar, industry leaders will guide attendees through an in-depth personal assessment of their credit union's access points. From broadening your reach to enhancing member experiences, this seminar will empower you with the tools to elevate your credit union's impact, expand your member base, and enhance your connection with the communities you serve. Visit familysecurityplan.com/credit-unions to learn more. That's familysecurityplan.com/credit-unions to learn more. The latest federal budget proposal recommends cutting discretionary awards from the CDFI fund, a move that sparked, let's call it backlash across the credit union industry. Credit union leaders warn this would hit underserved communities hard, from low-income neighborhoods to military families. Some argue that programs like the CDFI fund create a dependency on federal dollars. Okay, John, what's your take? Is the CDFI fund an investment or a handout?
Oh, that's a tough one. I think, again, it depends on the credit union. And, we are a CDFI credit union. We got designated probably 4 or 5 years ago. We got some grants. And at that point in time, when we got the grants, it was like, okay, here. We were like, okay, and the reporting was minimal to some degree, but we always made sure that we were doing what we were supposed to do, making sure the funds were used with the intent that we had them. Quite honestly, it's become so complicated with the reporting now and the requirements. So we're not going to, our certification runs out in September. We're not going to renew it because I have felt as though it's too much. It's almost like you need a full-time person to do a lot of the reporting. And we actually do use some consulting services through Inclusive. But quite honestly, what we're going to do is we're going to try to get our low-income designation. Probably going to be a little bit of a challenge for us here in Connecticut. But even without grants, even without CDFI, our focus is on working with the underserved market, the lower income to moderate income individuals, and creating products and services to help them. We would be doing that whether we had a grant or we didn't have a grant. I think what's now happened, and probably there were some credit unions taking it as a handout and using it for purposes that were unintended. And then they got to the point where, in my opinion, it's gotten so complicated. My team and I looked around, and I even consulted with the board. I'm like, is this even worth it to do this at this point? Is there another way to do what we were doing? And the answer is yes. And that is to have a strategy that is around what CDFI's intent was. And so we're going to try for the low income designation. But again, we're far off from the percentage that we need from the NCUA to get there, but that's still our focus. And our field of membership can extend throughout the United States. We're concentrated here in Connecticut, but one of the things, we have an association with the Community Impact Fund out of Colorado. So our membership, as long as people join that particular CIF, we can go forward and do the things that we're doing across the country. So we actually have to find pockets of low income areas, and the heat map for that has changed dramatically and changes over time. So, and there have been changes the way the designation works to get to the percentages that you need. So all of that tracking, all of that stress, we're just going to do it our way and not use the CDFI fund. And I know a lot of people have done very well with it. I know it's helped a lot of people, and I know it's helped a lot of credit unions, but it just, quite honestly, it didn't work the way we wanted to with all of the changes that the CDFI fund has had. And now you have this with it potentially being cut in our political world here. So
sounds like there are a lot of strings attached to these funds, lots of headaches attached to these funds. Becky, I saw you nodding your head every time John mentioned some of these headaches associated with this money. Talk to me about this money. Is it a handout? Is it an investment? What's your take, Becky?
Well, I think that his first comment is telling, and that is, we got money and we were like, really? You're giving us money? That wasn't very hard. And so that's a problem, right, with CDFI just handing out money without people really expressing too much of a need, right? So you just kind of raise your hand and you get a check. So that's not great. But we were a low-income designated credit union at Lone Star, and we looked at becoming CDFI, and we rarely used some of the low-income designated abilities access because of the red tape and the headache. And you might get a $2,500 grant to buy a couple laptops, but it would take somebody 25 hours to write the grant request, and all of the things you have to do to prove you spent the money how you said you were going to. It was more trouble than it was worth. And to John's point, this is stuff we were doing anyway. It wasn't like we weren't going to buy a laptop to go use in the community to help people. We were going to do that anyway. Great, we got a grant to pay for it, but we were going to do that anyway. And so I really think that the abuses were not happening in the credit union space, actual financial institution space. Maybe there were some abuses there, but I really think it's a broader problem with the CDFI in general, the fund, not individual financial institutions for the most part. So, maybe not too controversial of an answer, but at the end of the day, I do think it's a handout.
Some of the real worry, Becky, though, and I'd love you to address this, and you kind of already did, but I just think for the listeners, I think the big thing that I keep hearing about when it comes to this, or at least the outrage or the controversy, becomes people feel like the CDFI fund has helped a lot of underprivileged communities. It's helped a lot of those less fortunate. It's had a community impact. Do you feel like that community impact goes away at all because of the disappearance of these funds? I mean, you kind of said it.
I would say that credit unions are serving underserved communities, whether CDFI funds are there or not. And so that's our job. That's what we were built to do. That's what our members expect. And so the grant money certainly helps, but it doesn't change our mission.
That brings us to the end of the show. John, you were brought here by PFP Services, our sponsor, so I have to ask you, as a partner of PFP Services, talk to us about the impact and sort of the benefits that you have seen as a partner with them.
Well, first of all, they're all great people. We have such a good relationship with all of them. They're close to us, and they've done so many things to help us. And I worked with them at my past credit union. I used to work in Miami at Dade County Federal, and that's where I met a lot of them. And the amount of things that they can do to help your members, including helping sell your products and services to the membership is huge. And then add on to that the insurance products that they offer to help protect people's lives, and or in the event of some illness or something like that, they're there for all of that. But I think about business development in general and how important that is in communities and for the credit union to get out there, and whether it's meeting partnerships, and I'll use the word SEG because I think that's probably still used and common in the industry. If we wanted to identify a company we wanted to go into and get our foot in the door, these folks go in there, help us break the ice, introduce us to the company, because they're amazing in getting into the company. And they've been known to not only, and this is a while ago, but they would go into the branches. If there was a branch inside a grocery store, they'd walk the aisles, talking to people about your products and services, your brand, your credit union. And now they're doing a bunch of stuff online and via the telephone. And it also adds an amazing touch because they do things like reaching out to our members for their anniversary of their membership or their birthday. So it adds a whole realm to the business development world, to the relationships that you have with your members, to being able to get into a company that you've wanted to get into, but you might not have the resources. Like, that's the key thing. And when I got to Nutmeg, we're like, okay, I can't hire 2 or 3 people to go and do all of this. And they did it for us and continue to do that. So, and then on top of that, they give you some residual on products and services that you refer to them, and they refer your products and services back to you. So as they're talking to all these people, they're saying, well, hey, what about a credit card in addition to the life insurance policy that I just sold you? So I think the partnership's gone a long way. I would highly recommend them to any credit union that is not using them today.
Excellent. And I want to say that I'm sorry because you mentioned moving from Miami to Connecticut. And I want to just say I'm so sorry for your loss.
Well, I still have a place down there, so I spend as much time as I can in the winter there. So I think I have the best of both worlds.
Okay. Becky, final words based on our conversation today.
I think that I'll leave you guys with a phrase that Kyle Hotman says all the time, who is the only board member right now at NCUA. He happens to be the chair, but whenever he speaks, he talks about risk and equates it to planes. And I think that what we talked about earlier today, where credit unions were unwilling to take risks, even if they're managed risks, right? But then that holds us back. We're ultimately not doing what we're supposed to be doing and not serving the members in the way that we should because we're too afraid of risk. What he says is there were 0 plane crashes before we had planes. So we got to take risks, guys. Risk comes with the territory. We certainly can do everything we can to make sure that nothing bad happens, but something bad is going to happen. We can either learn from it or we can go roll up in a ball and hide in the corner. And if we don't, as an industry, start being more comfortable with risk, lots of ways to mitigate risk, then we're not thriving. And at the end of the day, we're not helping our member owners.
Becky, if anybody wants to get in touch with you, how can they do that?
LinkedIn.
And John, I have to ask you the same question. For listeners who are liking what you're putting down, what is the best way they can get in touch with you?
LinkedIn is probably the best too.
Awesome. I want to thank John. I want to thank Becky, and I want to thank our sponsor, PFP Services. You can check them out at familysecurityplan.com. And then obviously I want to give a special thanks to our listeners for continuing to support and listen to another episode of Grow Your Credit Union. If you like the show, please follow us on your podcast player of choice. And if you want to be a guest or you would like to talk about sponsorship opportunities, head to growyourcreditunion.com to learn more. Thank you for listening, and we will see you next time. Take care and bye-bye.